Welcome to another session of fundamental and technical analysis. So this is the sixth session in a series conducted by SC Securities. So anyone who is joining new, we highly recommend that you all check out our previous videos on this training session. So let's take a brief look at what we discussed last week. So during last week, we discussed about dividends. So we learned what is a dividend, what is a dividend payout, and what's the dividend yield. So these are few indicators that one should look at before purchasing shares. So dividend is sharing out the profit with the shareholders, and you can see what sort of a return would I get by investing in a company in terms of dividend, in addition to other benefits such as the capital gain. And I also spoke about the difference between interim and final dividend and about the dividend dates, how it happens. So today we are going to cover another important area, which is rights issues. Now, you all would have come across many rights issues. You all would have subscribed for many rights issues. And if someone is joining who's not very active in the market, we are going to start from scratch. Okay, now you all know when a company gets listed in the Colombo Stock Exchange, or for that matter, any stock exchange, one main way they do that is through an initial public offer, where the company issues its shares to the public for the first time. Thereby, the company would raise equity capital. Subsequent to listing in a stock exchange, a company can again raise equity capital by way of a rights issue. So rights issue is an additional capital raising exercise that a company can use. So what they do is they go back to their existing shareholders for another round of capital. Rather than trying to find new shareholders, they offer to their existing shareholders new shares. So if you are a shareholder of a company, if the company is announcing a rights issue, you as a shareholder has the right to subscribe for new shares of the company. So in a rights issue, two important things are that the capital would be raised from the existing shareholders, and the shares would be offered to the existing shareholders based on the existing shareholding, proportionate to the existing shareholding, right? The two important things are, in a rights issue, capital will be raised from the existing shareholders, and new shares would be issued to the existing shareholders in proportion to their existing shareholding. And as an incentive for the shareholders to subscribe for the rights issue, these new shares would be offered at a discount to the current market price. Or in other words, they would be offered at a price which is less than the current market price. So that's the basic definition of a rights issue. So in a rights issue, who would put money is the existing shareholders in proportion to their shareholding at a price which is less than the current market price. To make things more clearer, let's look at this simple illustration. A Limited has 1 million shares in issue, and the share is currently trading at 55 rupees. Now the company has announced a rights issue of 1 for every 2 existing shares at the rate of 40 rupees. So this company's shares are currently trading at 55 rupees. They are offering the rights at 40 rupees in the ratio of 1 new share for every 2 existing shares. So any shareholder who holds more than 2 shares in this company would be eligible to buy shares, to buy new shares at the price of 40 rupees based on their shareholding. Now, another important thing is, in a rights issue, it is only an offer to buy. It is not an obligation to buy. Just because you are a shareholder of that company and the company announces a rights issue, you are not obliged to buy new shares. There's no obligation as such. If you wish, you can. If you don't want, you need not buy. There's no obligation as such. It's only an offer. So when a rights issue is announced, a shareholder has several options. One thing he can do is he can fully subscribe for the rights he's entitled to. Another thing he can do is he can sell his right to some other shareholder. Third option would be he can partially subscribe for the rights. Not for his full entitlement, he can partially subscribe for the rights. Fourth option would be he can just ignore it, right? But that would be I would say, one should not do that, because you can at least sell your right to another shareholder and you can earn a return. Okay, so in this particular scenario, what we took, where the rights issue is 1-for-2, what it means is any shareholder, any existing shareholder has the right to buy one additional share for every 2 shares he holds at the price of 40 rupees. So that's the basic explanation of a rights issue. Now, it is important to understand how this rights issue process works. There are certain days, it's like a timeline. So you need to have a good understanding of the timeline of a rights issue. The first thing that would happen is that the company would announce the rights issue. So that I would say the announcement date. Now I have taken, for example, on 10th of May 2021, the company announced the rights issue. That's the official announcement made to the Colombo Stock Exchange. So from the date of announcement, there is a period until which any shareholder can buy shares of the company, buy existing shares of the company to be eligible for the rights issue, right? So you can buy shares until the ex-right date. So just like the ex-dividend date we discussed in the last week's session, ex-right date is the date where you are no longer entitled to the right? So in this case, the ex-right date is 15th of July. So the ideal entitlement date for you to be entitled for the right would be a day before the ex-right date. So that is 14th of July. So any shareholder who had shares as when the market closed on 14th of July is entitled for the rights issue. So between the date of announcement and the ex-right date, a shareholder has the opportunity to buy shares and hold it until the ex-right date and become eligible for the rights issue, right? So after the 15th of July or after the 14th of July, on 15th of July, you can sell your shares and still you are eligible for the rights issue because you had shares in your account a day before the ex-right date, or you had shares in your account on the final entitlement date. Now, after the rights issue goes ex-right, what happens is the company will go through the list of shareholders who had shares on the entitlement date, and they would send you the allotment letter. Now, allotment letter would tell you your entitlement and how much you need to pay. And these allotment letters would then be filled upon by shareholders and sent to the stockbrokers. But now, with the digitalization process, you are no longer required to fill your right application because it will be automatically lodged into your CDS account, right? It will be automatically lodged into your CDS account. But still, for all, you will get your allotment letter in the case if you wish to apply for additional shares, which we will discuss later. So after the ex-right date, you get the allotment letter, and after a few days, the shares would start to, not the shares, I beg your pardon, the rights would commence to trade in the stock exchange. Just like a regular ordinary share, the right would commence trading in the stock exchange. So it will be flagged as a right, not as a share. But you can just buy and sell rights the same way you buy and sell shares. So these rights would be trading in the market. And this right would trade until the renunciation date. So renunciation date is the final day where you have the option to buy and sell rights in the market and for you to lodge your rights in the CDS. So during this period, which I have highlighted in green, a shareholder can buy and sell rights, right? You can buy rights, you can sell rights, you can make a capital gain during that period, just like from a share. So during that period, you can do that. Then following the day after the renunciation date is the last date of acceptance and payment for rights. So if you have bought rights on 5th of August and on 6th of August, you can, that is the last date for you to accept your rights and make the payment. You can accept and make the payment before as well. And this is the final day for you to do that. That is the day following the renunciation date, right? So until the renunciation date, you can trade on your right. On the following day is the last date for you to accept and make the payment for the rights. Once you have made the payment for the right, after the last date of acceptance and payment, usually within 14 working days, the shares or the rights, the paid up rights would be converted into shares, and that will be lodged into the CDS. So your share balance in your account would go up by the amount of rights that you subscribe. So this is the timeline of a rights issue. Starting from the announcement date, the first area is the ex-right date, where you can buy shares to be eligible for the rights issue. After the ex-right date, there's a period where they will send you the allotment letter, and you can either directly send it to your secretaries and accept it, or you can start trading on your rights. And following the renunciation date, you can't trade the right any longer. You need to accept and make the payment for the right. And from that date, usually within 14 working days, your right would be converted into shares and lodged into your CDS account. Now, during this timeline, it is important for us to understand how the share price would behave. How the share price would behave once the company announces the rights issue, and how would it behave after the ex-right date, and how would it behave after the acceptance date. So to understand that, there are a few things which you need to know. Okay. The first thing is the theoretical ex-right price. That is, when the company announces a rights issue at a price which is less than the ongoing market price, what would happen is there would be an influx of new shares coming at a lower price. So ideally, after the rights issue, the price should come down. It should average out, right? So that is what you call the theoretical ex-right price. Now let's go back to the timeline. So this is the date which you announce it. And during this period, you only had shares to trade in the market. And following the ex-right date, your share price would get adjusted for the right? So what we looked at as the theoretical ex-right price is what would the share price be after the ex-right date. Let me repeat that. Until the ex-right date, you had only shares. And following the ex-right date, you are now entitled for the right. So for that right entitlement, your share price would get adjusted. So that is what we calculate as the theoretical ex-right price. It is a theoretical price, not that it will be the price. So what you do is a very simple calculation, a simple weighted average calculation. You look at the market value of shares before the rights issue. That is the number of shares in issue before the rights issue into the share price. To that you add the proceeds, what you get from the rights issue, right? That is the new number of shares issued into the rights issue price. Then the total value is divided by the total number of shares after the rights issue. So this is a very simple, it's a simple weighted average calculation. Okay. So the new share price after the ex-right date is known as the theoretical ex-right price, as I mentioned, and it is being calculated as follows. Now for you to understand this, let's again look at the same illustration. Now in the illustration we looked at, A Limited had 1 million shares in issue. One second, yeah. A Limited had 1 million shares in issue, and the share was trading at 55. So this is the price at which it was trading before the rights was announced. So to arrive at the market value of shares before the rights issue, you multiply that 1 million. This is that 1 million by the market price before the rights issue. So that is 1 million into 55. To that, you add how much value would the rights issue add. Now the rights issue is 1 for 2. That is, for every 2 shares held, there would be 1 new share created. So for 1 million shares, there would be 500,000 shares created because it is 1 for 2, half of what is already there. So 500 shares would be now created and that would be issued at a price of 40, right? So this is the market value before the rights issue, and this is the value that is being created from the rights issue. So you add them together. And now that total value needs to be divided amongst the total number of shares after the rights issue. So you had 1 million originally and 500,000 by way of rights. So now you have 1.5 million. You divide it by 1.5 million. So the theoretical ex-right price should be 50 rupees. So the share is currently trading at 55. Rights are coming at 40. So subsequent to the ex-right date, the price should get adjusted to 50. So that's why I said normally, typically, after the ex-right date, the share price would come down. Why? Because the new shares are being issued at a price less than the current market price. So there is a dilution effect. So this is the theoretical ex-right price. Now the question is, okay, we know the theoretical ex-right price. So you buy at 55 rupees today and you get entitled to buy shares at 40 rupees in future. But soon after the ex-right date, your share price will go down by 5 rupees. So that means you are losing 5 rupees theoretically, right? And it should come to 50. The next question you need to know is, how much should you pay to buy a right in the market? Now, as I explained before, not only shares, after the ex-right date, after the allotment letter has been lodged, the rights would commence trading in the stock exchange. So how much should you value the right? So it's a simple calculation like this. You call it the value of a right. How much is a right worth? Until the date at which the new shares can be purchased, shareholders may trade the rights on the market the same way they would trade ordinary shares. So what is the value you can place? Look at this graph. It's easier to understand. Now, the market price before the rights issue is 55. This is the price at which it was trading prior to the rights issue. Now, the rights issue price, new shares are being offered to the market at 40. So the difference between the current market price and the rights issue price is the rights issue discount given to the shareholders, right? So there's a discount of 15 rupees. There's a discount of 15 rupees. The theoretical ex-right price is 50. Theoretical ex-right price is 50, right? So that means if you buy a share at 55 and if you pay 40 rupees, your average price would be 50, right? Your theoretical price would be 50. Now in this scenario, the proportion was 1 for 2. So you buy 2 shares at 55 and you get entitled to buy 1 share at 40. You have to buy 2 shares at 55 for you to get entitled to buy a new share at 40. So your average price or your theoretical price is 50, right? So theoretically, your share price should come down to 50. So that you compare with the rights issue price, right? That you compare with the rights issue price. So theoretically, your price should drop to 50 and you are getting the right at 40. So that means if you are to buy a right, the maximum value you should pay is 10 rupees. Because theoretically, the price would average down to 50, right? After the rights issue, the price would average down to 50. And if you buy a right, you have to pay 40 rupees to get it converted to a share. Then the maximum value you should pay to buy that right is the difference between your theoretical ex-right price and the rights issue price. So the difference is 10 rupees in this scenario, right? I don't think it is very complicated. It's a simple idea. After the rights issue, after the expiry date, the price should average to 50. That's theoretically. Now, if you are buying a right in the market, not only you have to buy the right, you have to make the payment to convert it to a share. So you need to pay 40 rupees to convert it, right? And theoretically, after the conversion, the share should settle around somewhere around 50. So what is the maximum amount you are willing to pay? The maximum value of the right should be the difference between your rights issue price and the theoretical exercise price. That is the maximum price one should pay. So if someone is going to go and pay the right, going to buy the right, I'll say at 5 rupees, then there's an arbitrage profit. Why? Because you buy the right at 5 rupees, you pay 40 rupees to convert it into a share. So your total cost is 5 plus 40, 45. Whereas the theoretical extra price is 50. So there's an arbitrage profit of 5 rupees. So in that case, it is worthwhile you buying the right. But if the right is trading above 10 rupees, for example, we'll say it is trading at 15. So you pay 15 rupees and buy the right. Whereas on top of that 15, you need to pay another 40. So your total cost would be 55. And theoretically, the price would drop to 50. Thereby, you lose 5 rupees. So in that scenario, you should not that you should not buy. The value of the right is overpriced, right? So in a rights issue, you need to do two calculations. Calculate your theoretical expiry price and identify the value of a right. So then you can decide on what you need to do. You as a shareholder, when you have got your rights lodged into your CDS, you can trade on that right. So if the right is overpriced, you can basically sell your right. It's worthwhile selling the right and buying the share after the expiry date. Or if the right is undervalued, it is worthwhile you buy the right and convert it into a share and thereby generate an arbitrage profit. Okay, so that's what we have for rights issues today. Now let's look at the technical side. Saliya, over to you.
Thanks, Charitha. Welcome all of you once again to this session, which is the 6th now. I think you all can remember these two charts. Before that, let me show you the other chart regarding the investing, regarding the Expo Lanka, where I requested you all to watch what is going to happen in that range. And this is how it looks like today. Expo Lanka. This, in fact, on the 7th of July, we were looking at this. We were monitoring. And this is the area that we were watching. And at that point, I can remember one of our friends who participated wanted to know what will happen at which point we need to expect a trend extension. And I mentioned this 50-30 has to be broken out. And that is exactly what happened. Right, just to brief up what is going to take place now. Remember, the reason as to why we were talking about this area is due to the explanation that we were sharing regarding the candlestick formations. I mentioned at that point, each bearish and the bullish candlesticks have 5 types of candlesticks, starting from the most bullish to the least bullish, and the most bearish to the least bearish. Coming to the 2 candles that we see here, yesterday's candle, we can see that the high was 53 rupees and 50 cents. Incidentally, if you want to look at these levels, when I'm talking about these prices, you have to stay focused onto these 4 price points: open, high, low, close. When I'm moving my mouse, it goes when I stop it, you can see the values. So 53.50 was yesterday's high. Now that's a significant high. Why? What is the reason as to why, as to it being significant is exactly this value. This is also 53.60 that happened on the 15th of April. After the 15th of April, only yesterday it went and tested that area. Although it's 10 cents below that high, we tested that area. So we basically went into a significant resistance area yesterday, right? Other factor or other feature that I would want you all to monitor is the volume behavior. When we were explaining about the volume, I mentioned, now the volume indicator is here. You have this black thin line, which is the 20-day volume average of the volume, right? 20-day average of the volume, right? And that is given here. So the latest figure of that, the average, which is in black, as you can see, is 3.739 million. Now, what is in green is, since it closed bullish in the sense higher than the open, the candle is green. Hence, the volume also will be shown as green. And the volume today is 3,495,000 shares. Average is 3,739,000 shares. It'll be interesting to see what the psychology behind the ones who are collecting now. Immediately, if the stock to break 53.60, because when the price breaks out of the previous high only, we say that the market is, or the prices are increasing based on the interpretation of technical analysis, right? You have the higher lows and higher highs, right? Now we have tested, we had higher lows, tested higher highs. So for it to go up beyond that, then what will happen to the volume behavior? Will it be below 3.739 million? Just like yesterday, today the volume is below. Yesterday, what will happen? Yesterday and the last 3 days, we can see the volumes were higher than the average. Today, the volume is lower than the average. Just by looking at the A-Trade or your online terminal, you feel kind of, pumped up because we did 3.5, almost 3.5 million shares. So we saw changing hands, and that's a significant amount and stuff like that. But in technical analysis, we look at the volume behavior and we look at the direction of that behavior. That is one of the reasons as to why technical analysis is very important. While the volume is behaving, we can see two types of candles formed in the last 2 days, right? Now, if you can remember the least bullish candle, this is one such candle where the close and the open and the low is at the bottom of the price range, right? A bullish candle or second most bullish candle is something like here. What was given today, or what happened today, where the open and the close is at the upper range of the upper section of the range, right? So now this is a bullish formation. It's a bullish close. Only problem is that it is below the average volume. Now, why that is a problem? The problem is when the volumes are falling, the price goes into a consolidation. So there are two types of consolidation. One is at the upper end of the trend or at the lower end of the trend, right? At which point we classify as the upper end and the lower end sometimes is a bit tricky. You know, by the looks of it, we can see that this is at the upper end because we are testing this area and this area. But if you go back and see, it's not the case. The upper end is here. We are in the middle section, right? So in the short term, it's at the upper end, right? And is finding resistance at this 53.60. Therefore, whether this is going to go into a consolidation is something that we are watching, right? It can go into a consolidation. What if it goes to a consolidation? Then there can be a retracement. Is that retracement bad? It is not so. It is the important feature that we see in a trend extension. When the trend is going up, right, you need a consolidation to take place, right? So the next consolidation, we have to be open-minded and we have to expect a consolidation. And there are many reasons as to why we see those consolidations. But that's for advanced stage of analysis. We are not yet in the advanced stage, but after a few sessions from now onwards, we will be talking about the advanced stage of technical analysis, right? For the time being, we have to stick with what we discussed last week, the moving averages. In the case of the moving averages, we discussed about 3 types of moving averages, as you all know: the simple moving average, exponential moving average, the weighted moving average, right? I think there is a question. Could you explain a consolidation, please? Fine. In a consolidation, Mr. Panaloka, is something where the prices go sideways. Now, in order to understand the sideways, first we have to spot a low, meaning a swing low, ideally, or a swing high. And now to make things simpler, we see a swing high now. I mentioned about the swing high two sessions ago. Now we have spotted a high. We have spotted a high. Once we spot a high, until that high is broken and the price goes above that, right, the demand and supply is going to play and dictate terms, right? Since we have gone into a high, the trend has paused, right? The trend has gone up with higher lows and higher highs, paused. That is a resistance. So in a resistance, you have a high. Now we want to see where the low is in that resistance area. In the resistance area, when you spot a high and a low, in this case, a high is already done, right? Now we need to see where the low is. At the moment, of course, there is a low. 52.20 is a low. 53.50 is the high, right? So we need to we need to figure out whether the prices are going to trend between a high of 53.50 and a low of 52.20. If the prices are not going up or coming down within these two high and the low points, the quantity or the volumes are getting accumulated at that range, right? So when the accumulation is taking place, right, the name itself, which is known as consolidation, gives you the idea that this uptrend is building up into a situation where it can extend above the present price or break down below the present low. Present high extend above the present high or break down below the present low, right? So at that point where the demand and the supply is at play, and when it is happening for a several number of days, right? In this case, we are using a daily chart, so the time period is days. So for several days, if that happens, for several hours, if it happens, for several minutes, if it happens, that is an area of consolidation. So when we spot the high and then you have that consolidation or the accumulation taking place, right? That's a consolidation at the resistance point. When you first spot the low, swing low, and you see the same type of an action happening, right? That is a consolidation at the support area. So there are two types of consolidations. One, once you spot the swing high, you have a resistance, and in that resistance, you have a consolidation. Or when you spot a swing low and you have an accumulation taking place, a consolidation at the support area. That's the two types of consolidations that are taking place, and we loosely call them the support areas or resistance areas. But that is an area of accumulation which will be within which you have the distribution of the sellers and the buyers. Buyer accumulates, seller distributes, right? So both eventually one section is going to win, and thereafter we will respect that extension or the breakdown. Okay, so staying with the moving averages. Now, out of the three moving averages, I'm going to take exponential moving average, and I'm going to use the 12 period and the 26 period moving exponential moving average, and I'm going to explain how we are going to use two moving averages of the same kind and understand how the prices, how when the prices are going up or when the prices are coming down, how best we can make use of the moving averages, right? There is a reason behind me using the 12 and the 26 that I will explain later, probably next. I will just basically sum up with that explanation at the end of the session, and I will be explaining it further in the next session. Based on the 12 and the 26-day moving averages, right? I can just casually tell you that when the prices are crossing above, when the moving average, the faster moving average is crossing above the slower moving average and stuff like that. But I'm going to break it down and make it a little bit simpler for those who are interested in learning, right? And I appreciate the fact that you all are participating. And I take my time to explain to increase your knowledge, because I can see that since you all are interested and keen, only you all are participating for these sessions. So now, talking of the moving averages, last week I mentioned that the moving averages are used for two reasons. One is for the crossover, the other is for the support or the resistance, right? So at any given moment you use the moving average, you have to remember at the back of your mind, you need to know that this is to look at the crossover and the support and resistance areas. Okay. Now, talking of the support and resistance areas, price itself has a support and resistance area. That is the most important. right? Not the moving average, support and resistance areas, the price. Then when we are using the moving average lines, the price is what is going to come to that line to dictate terms whether it's taking support, whether the price is taking support at the moving average level or taking resistance at the moving average level, right? So this is the start after the COVID, 11th or the 12th of May 2020. The stock starts at 1 rupee and 90 cents. The stock starts at 1 rupee and 90 cents. There you can see the range. It comes down to 1 rupee and 70 cents. And the high is also 1 rupee and 90 cents. Close is 180. The next day, it goes up, meaning the low is higher than the previous low. Previous low is 170. Now it's 180. Higher high. Why? The high is 220. The next day, it moves up further. 210 is the low. 250 is the high. Still a higher high. Then you have the next day, higher low and a higher high, right? And it opens at a high of 260, closes at a low of 240, where the high and the low is also the same. The moment that happens, right, we can see one moving average line has been tested and got rejected. The 12 moving average, 12-day moving average was tested when it went up to 260, but it closed below when it closed at 240. Next day, again tests the 12-day moving average, but didn't close above. The next day, the next day. So 4 days in a row, we can see that the price is below, closing below the moving average. The 5th day, it went and closed above the moving average. The next day, again, testing the same moving average. Right up to here, you can see that this moving average is being tested. What is happening to the moving average? Obviously, that's also going sideways, nowhere, more or less, right? And remember, this is the 12-day moving average, right? So the 12-day moving average is going sideways. The prices are also testing the moving average and ranging sideways. Thereafter, we can see that the price is closing above the moving average, and slowly the prices are going and testing the 26-day moving average. Here you can see that the 26-day moving average is being tested, right? So while that is happening, now remember what is taking place when we are using the moving average lines. First, it is the price that has to break or cross these moving averages, irrespective of how many moving averages you have, right? So when this happens, we can see that both the 12-day moving average and the 26 EMA is being broken out. Thereafter, we can see that the 12-day moving average is inching up for obvious reasons, because the prices are high, average also has to increase. So the average is increasing on the 12-day moving average, and it crosses above the 26-day moving average. And now the prices are taking support at that level. As a result of it moving sideways, we can see that the 12-day and the 26-day is also edging on top of each other, right? And then it goes up, the prices. Along with that, we can see that the 12-day moving average is also inching higher because the prices are extending. What do you mean by prices extending? The prices extending means you can see that this is the high and this has broken the previous high. As such, the moving average values of the 12-day moving average is higher, right? Then within this area, you can see that the prices are trending sideways, then it drops. Now, when this is dropping, right, you can see that, of course, the prices are coming down below the 12-day moving below the moving averages, but taking support at this level. Taking support at this level. Remember, that's why at the outset itself, at the start itself, we emphasized on the price action. The prices and volumes are what we use. We pay a price to buy a number of shares, volume. We pay the price to buy the volume, right? And on the T+3, we pay genuinely, right, to a bank. It's not just, earlier also I mentioned, these are not drawings, right? There is a lot of thinking behind these ranges. You see open, high, low, close, right? Within the low and the high, how much of things that are taking place, right? So because of that, we have to really master the price action, the prices, right? All these other little things, these lines and so many other stuff are there in existence purely because of the prices. So here we can see that it broke below the 2 averages, but taking support here, right? And thereafter there was a reversal. Then prices extend. We can see the prices are extending. When the prices are extending, now over here we can see this high was broken out. This high over here, or rather this high, you see here, is broken out here. So the higher high formation, lower high formation is happening, right? When you see this taking place, you know that the trend is extending, right? And thereafter it just goes, still extends into a higher level, right? Moment. We were here. So the prices are extending into a major rally. Okay, to a major rally. So how are we going to make use of these lines for our buying and selling, right? The rule is, when we are using two types of moving averages, or two moving averages with different time frames, they are known as a short moving average and a long moving average, or a faster moving average and a slower moving average. If you're talking of a faster moving average, what it means is that it is a short-term moving average. When you say it's a slower moving average, it is a long, or the number of days are higher than the shorter one, right? So you have faster moving average and a slower moving average. Here in this case, I have taken the faster moving average as a 12 EMA. The slower moving average is the 26 EMA. So when the price crosses above the two moving averages, as we can see here, right? You wait until the slower moving average, or rather the fastest moving average, cross above the slower moving average. 12-day moving average has to cross above the 26-day moving average, right? And at this point, preferably and ideally, the volumes have to increase. If the volumes aren't increasing, that means it is on a consolidation or a sideway movement. Again, right? We spot the swing high here, comes down, goes sideways. We spot a swing low here. So within this swing low and with this within this swing high, there's a consolidation. An accumulation is taking place, right? There's a slight movement of the volume at this point, right? We can see the volume going up to 6.9 million, where, with an average of 6.5 million, right? At an average when at a time when the average is 6.58 million, the daily volume went up to 6.9 million, right? So at this point, right, you can start positioning yourself with your purchase orders, right? Ideally, in a very fast market, very active market, the volume will help you. But if you are focusing yourself purely on the basis of the way the prices are behaving within the price support and resistance levels and the crossovers of these moving averages, you will be able to understand whether you're going to take a position or not, right? When you're doing this, you have to think to yourself, talk to yourself, and identify what is happening, right? That's how you will be able to make a call. Otherwise, just because by the looks of it, if somebody is going to tell you just when the crossover happens, you buy, that is further than the rather that's further from the truth, right? You have to be realistic when you're placing your buy order. Once you make the buy order, right, in the Sri Lankan context or any part of the world, right, for the most minimum realistic profit figure, you have to place a sell order ideally for a smaller percentage of your position. For an example, if you have 10,000 shares, for the first 25% of your volume, that is 2,500, or it can be 10% of your volume, that is 10,000 shares, you have to put your price, sell price, and ideally a GTC price for after calculating your return on investment, right? If you get a 5% return within a week, into 4 is 20%. Annualized, it's going to be 240%. Is it realistic? You have to understand. If you get 5% within a week, you need to understand that it's a fantastic return. That's for your minimum amount, right? And thereafter, you will be able to understand how the prices are behaving. Based on the price behavior, the next way of looking at it by using the moving averages, how we are positioning ourselves is that we wait for, if there is a price retracement. Remember I said that the moving averages are used for support and resistance areas, right? We figure out that there is support, but for the price, not for the not based on the moving average lines, because the price has fallen below the moving average lines, right? So if you're using the moving average lines, then you have to wait for the prices to go back up, reverse and go back up, right? At this area, now that you have already figured out, taken a position, you can accumulate further at this area, right? But if you are a person who is taking a trade where a trade is the classification of a trade is that you have the buy, you have the sell, then you have the stop loss. If you do not have a stop loss and you call yourself a trader, there's something wrong, right? So in a scenario like that, it is not it is not worth holding on to a position, right? If it breaks, because it could have come down. Now this is history, so we don't care, right? But if something happened and if this support was not respected, then we this is the lowest we should tolerate, that is 280. We should have cut loss. That is for a trader. But if you are a person, most they think of trading and then become investors, right? Because they don't want to stop loss, they start talking well of a company, right? But if they get forced sold, they will talk bad about the company, the market, and everything, right? Under the sun, they will be blamed. So you need to understand whether you are an investor or a trader. I'm talking about investing, right? So if you have figured out Expo Lanka's opportunity, then this is a fantastic opportunity to accumulate further. But realizing your profits, right, as an investor is known as an active investor, right? So you have 10,000, you have done away with a profit margin, and probably you would have sold maybe 10,000 shares or 2,500 shares. You have 75% to 90% still intact. So you add, right? You can add at this area. Then you still you can have the same theory where a minimum amount at the most realistic minimum return on investment, you can just put your sell orders and carry on. So while we move on, we can see that over here, this got supported. This is another area of adding to your position. Then the prices extends, then comes almost to the 12-day moving average. Another area where you can add more. And the reason as to why you need to have at least a minimum with the most realistic minimum return on investment is because you can just keep adding as long as the prices are touching or kissing these moving averages. But at one point, it goes the other way around. If you had been selling and realizing profits, you would have been rewarded, right? You would have been rewarded. But if you had been a trader, right, this is something that you need to understand. When the moving averages, first, when the prices are breaking below the or crossing below the moving averages, and then when the moving averages are meaning the faster moving average breaking or crossing below the longer moving average, these positions have to be minimized or cut down completely, right? That is for a trader. But if you're an investor who believes in the counter, you have shut down certain parts of your position. Therefore, you can decide when a stock is going sideways. The negative of this trade setup, right, world over, by using the moving averages, we need to understand the moving average is derived by the prices. So when the prices are going sideways, the moving averages also will go sideways. That's why just because it goes up, you buying and comes down selling won't work, right? So that is to do with the moving averages. The reason as to why I took the 12 and the 26 is to explain and show you how we use the moving average convergence divergence, which is popularly known as MACD, which we are going to cover in the next session. So with that, I will wind up for the day. Thank you very much. And over to you, Charitha.
Right. Thank you, Saliya. We will wind up for today. Thank you for joining, everyone. And if there are any questions, please raise your questions now.